Imagine a stock that just rocketed up, I mean, over 78% in exactly 2 weeks, just riding this massive, unstoppable wave of AI data center infrastructure.
Right. Which sounds like a wildly strong buy on paper.
Exactly. Sounds incredible, right? But what if the company's own executives are out there aggressively dumping millions of dollars in their own shares directly into that rally?
Yeah, that changes the picture completely.
It really does. And on top of that, you have professional analysts quietly sitting in the background, warning of a potential 46% crash.
Which is just a massive divergence from what the retail crowd is doing.
Completely. So are you looking at the next big tech giant, or are we staring at a classic retail trader trap?
It is honestly the ultimate market paradox right now. I mean, you have this incredible, almost violent price momentum colliding head-on with some very grim, very grounded financial realities.
The divergence between the narrative and the numbers is just massive.
It really is.
Well, welcome to the deep dive. Our core mission today is to tear apart the financial statements, the institutional order flow, and, the raw technical data on Navitas Semiconductor Core.
Right. Ticker symbol NVTS.
NVTS, exactly. We need to figure out exactly what is driving this extreme volatility. I mean, is this a genuinely undervalued hidden gem leveraging the AI boom, or is it a mirage fueled by buzzwords?
That is the million-dollar question.
Before we get into the weeds, though, do us a huge favor. Like this video, subscribe to our YouTube channel, and honestly, it's compulsory that you leave a comment with your feedback on this one. We really want to know your take.
Yeah, let us know what you think down below.
And remember, we are here to analyze the data and fuel a natural human debate for you, but this is entirely for educational purposes.
Absolutely. No financial advice here, guys.
None at all. Okay, so let's unpack this. How exactly does a stock surge 16% in a single trading session?
Well, what's fascinating here is the sheer velocity of the move. I mean, to really grasp how wild this current valuation is, we have to look at the historical context of their 52-week range.
Right, because this wasn't always a high flyer.
Not at all. This is a stock that was scraping the absolute bottom at $1.77.
Wow.
Yeah, it's essentially left for dead. And then, out of nowhere, it recently hit a high of $17.79.
A spread from under $2 to almost $18. That is a 10x move from the lows.
It's massive.
But the acceleration over the last 14 days is what really caught my eye, up 78.8% in 2 weeks.
Yeah, from a technical analysis standpoint, it has completely decoupled from its historical averages.
Completely. I mean, it's trading at $15.33 right now, leaving its 50-day moving average in the dust, which is down at $9.39.
Right, and it's well above its 200-day moving average of $11.71.
So that decoupling, that's what creates the tension we're seeing, right?
Exactly. That tension is key. The momentum indicators are currently screaming that this rally is severely overextended. I mean, the relative strength index, the RSI, is sitting at an extreme 91.
Wait, an RSI of 91? And that isn't just hot.
No, it's practically melting.
Right. Think of it like a stretched rubber band. It doesn't necessarily mean the company is fundamentally flawed or, that the technology is bad.
Sure.
It just means the immediate buyer liquidity is mathematically exhausted. The rubber band usually has to snap back closer to the moving average to reset, right, before it can stretch any further.
That's the perfect mechanism to keep in mind, actually. The engine is running way too hot, and the immediate buyers have just tapped out their capital.
So what does that mean for the other indicators?
Well, if you look at the MAN CD, it's sitting at 0.58. Now, technically, that represents a bullish crossover.
Which explains the initial catalyst for the spike, I guess.
Exactly. But under the surface, the volume dynamics are flashing some serious warning signs. I mean, we saw trading volume hit 87 million shares during this latest jump.
87 million shares changing hands in a single session.
Yeah.
That does not happen organically. You don't get 87 million shares traded just because, retail traders are talking about it on message boards.
Oh, absolutely not. That is institutional algorithmic volume right there.
Right. That's high-frequency trading stepping in to exploit the momentum.
Spot on. And when algorithmic volume takes over like that, the technical levels become absolute battlegrounds.
So where are the battle lines drawn right now?
Well, if the momentum somehow finds another gear to push higher, resistance is sitting really heavy at $16.61.
Okay. Which was a recent intraday high, right?
Yep. And then after that is $17.10, and finally that 52-week peak of $17.79.
But if that rubber band we talked about finally snaps,
The floor falls out.
It really does.
Yeah, immediate support is down at $13.20. And if the algos switch from buy to sell and break that level, the major trend support doesn't kick in until way down at $11.63.
So there's just a massive air pocket underneath the current
It's
price.
a huge one.
Right. But an 87 million share volume day doesn't trigger out of nowhere. I mean, technicals only show us the math of the trade.
They show us the footprints,
Yeah,
basically.
wait, to figure out what triggered those institutional algos to buy in the first place, we have to look under the hood at the underlying financials.
And the massive strategic pivot Navitas is pitching to Wall Street right now.
Yeah, and this is where the narrative completely divorces itself from the current balance sheet. Let me throw these numbers at you because the math feels entirely disconnected from reality.
Let's hear it.
So Navitas currently commands a market cap of roughly $3.54 billion. They are valued as a multi-billion-dollar enterprise. But look at their fiscal year 2025 income statement. Total revenue was down 45% year over year.
Wow.
Yeah, they brought in just $45.92 million.
A $3.5 billion valuation on less than $46 million in shrinking revenue. I mean, for a hardware company, that is astronomical.
It gets worse. Their net income is a brutal negative $116.95 million.
So wait, let me get this straight.
Yep, go ahead.
They are valued at over $3.5 billion. They generated $46 million in sales, and they lost well over double what they actually made.
That's the reality. How on earth is the market rewarding a business model bleeding that much cash with a 78% rally?
Because the market isn't buying Navitas for what it is today.
Okay, so what are they buying?
It's buying the narrative of what Navitas is attempting to become. I mean, the company is officially in what they're calling a transition year.
A transition year.
Yeah, right. They are intentionally sacrificing their near-term revenue. You see, their legacy market was mobile technology. So silicon-based fast chargers for consumer electronics.
Oh, like phone chargers and laptop brick.
Exactly. But consumer electronics demand is weak right now, and silicon is just a low-margin race to the bottom.
So they are aggressively pivoting away from legacy silicon.
Yeah, into GaN and SiC, gallium nitride, and silicon carbide.
Okay, and why is that so important for this AI story?
Well, we know you can't run next-generation AI data centers on legacy silicon architectures. The thermal limits are just too restrictive.
Right, because the servers get incredibly hot.
Extremely hot. The power requirements to run these massive artificial intelligence models, like the GPUs from NVIDIA and AMD, are astronomical. Silicon literally melts under that kind of load.
Wow. So where do gallium nitride and silicon carbide fit in?
They can handle significantly higher voltages with a massively reduced thermal footprint. They are more efficient, they generate less heat, and this is crucial, they take up less physical space in the server rack.
So, Navitas is betting the entire farm on becoming the foundational power infrastructure for the AI revolution.
Yes. But pivoting an entire semiconductor fabrication pipeline away from consumer mobile chips to wide bandgap materials for enterprise data centers, that takes a staggering amount of capital.
Which explains the massive net loss we just talked about.
Exactly. The heavy losses are driven largely by a $49.8 million investment in pure R&D. They're essentially retooling their entire technological moat.
Normally, a cash burn of $116 million on shrinking revenue would be a death sentence for a company this size. You'd expect them to be heavily leveraged just to keep the lights on.
You would, but looking at the balance sheet, the asset column is surprisingly robust.
Really?
Yeah, they actually have a remarkably sturdy runway for a company in transition.
Yeah.
Total assets are sitting at $500.47 million.
Okay. And how much of that is actually usable?
Well, $207.8 million of that is in working capital.
Right.
And the real kicker, their debt is practically non-existent.
Seriously, a hardware company with no debt.
Pretty much. Total debt is just $6.47 million, which is mostly just capital lease obligations.
Okay.
They aren't bogged down by crippling interest payments.
Okay, so they aren't leveraged to the gills, but their free cash flow is still negative $44.37 million.
Right.
So they are bleeding cash to scale these new GaN and SiC products, but they have a thick enough wallet to bleed for a few quarters without facing, immediate bankruptcy.
It buys them time. But time is a luxury in the semiconductor space.
That's true. But here is the major red flag for me. If a company is burning $44 million in cash to chase this AI dragon, it begs a crucial question.
Which is,
Who actually believes they're going to pull this pivot off? Because when we dig into the 13F filings and the insider order flow, the divergence between the retail hype and the institutional action is just glaring.
yeah, the insider activity is perhaps the most concerning part of the fundamental data.
Right.
It is aggressively bearish.
So bearish. Over the last 6 months, directors and the chief financial officer have sold over $34 million in shares.
And insider purchases over that same time frame.
Zero.
Zero.
Hmm.
Not a single share bought by the people who actually see the internal order books.
Right. If I'm holding equity and I see the CFO unloading tens of millions of dollars of their own stock directly into a massive retail rally,
That makes you nervous.
incredibly nervous. Why take that much liquidity off the table if you truly believe your technology is about to capture the AI data center market?
It absolutely paints a picture of executives using retail liquidity as an exit strategy. I mean, there's no sugarcoating that.
And when you analyze the institutional activity, the quote-unquote smart money filings, we see a massive contradiction in how the professionals are playing this too.
If we connect this to the bigger picture, looking at the Q4 2025 filings, you have major traditional asset managers like Invesco and BlackRock making huge additions to their positions.
But on the flip side, Renaissance Technologies completely liquidated their entire stake.
Yeah, they dumped everything.
How do we reconcile that? You have the smartest quants in the room dumping the stock, while the biggest asset managers in the world are accumulating it.
It comes down to the fundamental difference in how those two entities trade.
Okay, break that down for us.
Well, BlackRock is playing the long-term fundamental thesis. They manage trillions of dollars, right? They are buying the 5-year narrative that wide bandgap semiconductors are mandatory for AI scaling.
So they aren't looking at today's chart.
Not at all.
Yeah.
They don't care about a high RSI today. They are parking capital for 2030.
They are buying the sector, not just the stock.
Precisely. But Renaissance Technologies is a quantitative hedge fund. They rely entirely on mathematical models and statistical risk management.
So they saw the numbers and ran.
Basically.
Mm.
Their algorithms likely flagged the extreme RSI of 91, the massive standard deviation from the moving averages, and the deteriorating free cash flow, and just triggered a mechanical liquidation.
The quants saw the rubber band stretching too far and cut their risk entirely.
Yeah.
So the quants are managing risk, traditional asset managers are buying the decade-long narrative, and retail traders are caught in the middle, driving 87 million shares of daily volume.
Which is a dangerous place to be.
It really is. Which brings us to the ultimate question for anyone looking at this ticker right now. How are professional analysts actually valuing this stock today? Are retail traders walking blindly into an overvaluation trap, or is this genuinely a misunderstood treasure?
Well, if you look at the analyst consensus, it's very cautious hold. But the price targets tell a much darker story. The average analyst price target is $8.15.
Wait, 8.15. The stock's currently trading at 15.33.
Yep.
An 8.15 target means the consensus among analysts is that this stock has a massive 46% downside.
They expect nearly half its value to be wiped out.
That is brutal.
And the valuation models back up that pessimism.
Yeah.
Simply Walsing claims the stock is trading 51.8% above its narrative fair value.
51% overvalued.
Yeah. Let's look at the price to sales multiple, the PS ratio. It is sitting at about 42.
A price to sales ratio of 42. So investors are paying $42 for every single dollar of revenue Navitas currently generates.
Which is insane for their industry.
It really is. To put that in perspective, a PS of 42 is something you'd expect to see from a hyper-growth, asset-light, software SaaS company with like 90% gross margins.
Right. A company selling code, not physical goods.
Exactly. Navitas is a hardware company. They have physical fabrication costs, supply chain logistics, material costs. A PS of 42 for a hardware company whose legacy revenue just shrank 45% is just astronomical.
It's priced beyond perfection. It's priced as if they have already conquered the AI market.
So given all this data, the PS ratio of 42, the negative income, the insider selling, the quant liquidation, the analyst targets literally all the present-day mechanics scream overvaluation trap.
They really do.
Why would anyone hit the buy button right now? What is the actual bull case here?
The bull case requires you to completely ignore 2025 and 2026.
Okay, just look past the next 2 years entirely.
Exactly. The argument is that the AI data center opportunity is a generational shift in power infrastructure. And Navitas isn't just hoping to get a piece of that pie.
Right.
They have a confirmed $450 million backlog in design wins.
Okay, let's unpack that. A $450 million backlog means the future revenue is technically visible.
Correct.
These aren't just theoretical sales. These are actual contracts and design wins where their tech is slated to be integrated into future products.
Exactly. And the confidence in that backlog recently got a massive boost. They appointed an industry veteran, Gregory Fischer, to their board of directors.
Fisher, he's the former vice president at Broadcom, right?
Yes. And Broadcom is an absolute titan in the networking and semiconductor space. The bull argument is that Fisher wasn't brought in to manage a failing mobile charger company.
That makes sense.
He was brought in to steer that $450 million backlog and integrate it into the massive AI supply chains he already knows so well.
So if they execute that flawlessly, a $3.5 billion valuation today might actually look cheap by the time we hit 2029.
That's the bet.
I see the logic. But that requires a flawless execution over several years. And the bears have a lot of mechanical ammunition right now to argue this stock won't survive the transition without inflicting serious pain on current shareholders.
Oh, definitely. The bear case focuses on the brutal reality of the next 18 months. Core revenue is expected to shrink another 21% in 2026 as those old mobile silicon markets fade out entirely.
And that's well before the heavy AI data center revenue hits the income statement.
Exactly. Combine shrinking revenue with that extreme PS of 22, and you have a recipe for a massive multiple compression. Plus, you have to factor in the dilution risk.
Oh, right. Let's talk about the mechanics of that dilution risk. We mentioned their strong balance sheet earlier, $207 million in working capital. But with free cash flow at negative $44 million, they are burning cash fast.
Very fast.
How do they replenish that?
Through private placements and secondary offerings, they have a history of leaning on the capital markets to fund their R&D.
So if you are management and your stock just pumped 78% on retail hype.
That is the absolute perfect liquidity event to issue an at-the-market offering.
Right. They can just print new shares, sell them into the rally, and pad their balance sheet.
But for current shareholders, that means your slice of the pie just got significantly smaller.
And the stock price will likely tank as that new supply hits the market. You're basically subsidizing their R&D while you wait for the AI money to arrive in 5 years.
And 5 years is an eternity in the semiconductor sector. It raises a critical question about timelines and expectations, really. Well, if you are looking at the short term, like the next few weeks, you are staring down a highly volatile algorithmic environment. The ultimate imminent catalyst for this stock is their upcoming earnings report on May 5th, 2026.
May 5th. That is the day the narrative collides with the actual ledger.
Because the stock is priced for absolute perfection right now, again, an RSI of 91 and a 42 multiple,
Yeah.
any slight disappointment in that earnings call could be disastrous.
What happens if they miss?
If Navitas fails to show margin improvement on May 5th, or if their forward guidance on that backlog is delayed by even a single quarter, it could trigger a violent correction.
Back down to those support levels at 1320 or even 1163.
Easily.
So in the short term, you are effectively playing a highly volatile game of earnings roulette. You are betting that a company bleeding cash can deliver a flawless quarterly report to justify a massive technical breakout.
And medium to long term, it's simply a waiting game. The broader consensus is that the real tangible AI data center revenue from GaN and SiC won't actually materialize on the balance sheet at scale until 2027 or 2028.
Wow.
Yeah, so you have to ask yourself, does the market have the patience to hold this stock at a premium valuation for 2 more years while the company navigates shrinking core revenue?
So to summarize this dynamic for you all, long term, if you are a bull, you are betting that a company currently bringing in just $45 million can seamlessly execute a multi-billion-dollar pivot into the most ruthless, heavily capitalized tech sector on Earth.
AI infrastructure is no joke.
It's not. Short term, if you are buying here, you are betting against the technical indicators. You are betting against the quant funds like Renaissance, and you are betting against the company's own executives who just dumped $34 million in stock.
It requires an iron stomach, regardless of which side of the trade you take. I mean, the tension between the chart's explosive upward momentum and the stark reality of the cash burn. It's one of the most extreme structural divergences we've seen in the semiconductor space this year.
It really is a masterclass in narrative versus numbers. We've torn through the exhaustion of the technicals, the massive R&D burn required to scale gallium nitride, the institutional divergence, and the dilution risk.
It's a lot to process.
It is. But as we wrap up this deep dive, I want to leave you with one final thought to mull over. We know that the insiders, the directors, the CFO dumped $34 million in shares over the last 6 months, right before this massive retail rally really took hold.
Right.
But think about the timeline. May 5th is just around the corner. If the people running the company, the ones who actually see the internal order books, the real-time profit margins, and the true cost of this AI pivot, if they didn't want to hold their own stock going into this specific earnings report.
What exactly are they expecting to happen when they open those books to the public?
Exactly. Let that sink in. Thank you for joining us on this deep dive. Keep questioning the data, stay curious, and we will catch you on the next one.